Hey guys, so a lot of people have been asking me lately, how do you trade lower time frames? How do you catch higher risk reward or our setups? How can you take advantage of high volatile markets like gold on the lower time frame and be able to get in and out and in a short period of time? And not only that, but maximize your potential gains, minimize your risk. What I'm going to be doing is I'm going to give you guys a strategy that you can use on things like gold, NAS 100, US 30, whatever it might be. It's going to be a lower time frame setup strategy that gives you the biggest R to R within, the same session, give or take within the same hour, sometimes give or take within a few minutes based on the setup. So what I'm gonna do is I'm gonna hop on the computer and I'm gonna break down how you guys can start catching trades like the one I'll show you here somewhere on the screen right now. There's a few key things that I've been consistently seeing on the lower time frame on gold, and there's a setup that keeps on happening on the lower time frames, specifically the 1 minute and the 5 minute time frames. This thing just keeps on happening, right? What I want to do is I want to go over how you can catch these setups where you are able to catch those 1 to 9s, 1 to 10s, anything above a 1 to 3 is obviously phenomenal, but you can catch insanely amazing risk reward opportunities. The setup that I'm going to be talking about specifically, I know we already showed you guys on the screen, but the setup I'm going to be talking about is this one right here. Before we go into that, there's a few key things that you need to understand about price and structure and having some rules to be able to trade this consistently. Lower time frame rules, or we could just put LTF rules, whatever you want to say. It doesn't matter to me. In regards to it, I would say rule 1, understand where you are at in for sure. So that's going to be rule 1, understanding where you are in structure, right? You have to have an amazing understanding of market structure. Now, looking at a chart like this, you might be thinking and saying, okay, where is the market structure, right? How can I understand rule 1 if I don't know what I'm looking at? Now, overall, on this specific day when we're trading gold was very, very bullish, and then bullish, started showing indications that it was going lower, and then we started breaking structure. So it was going up and up and up and up, then it started slowly going like this, then it started going like that, right? So in regards to that, we saw price go from bullish to bearish, right there. That is the shift right there, that green circle. That is the shift from bullish to bearish. Now, as we started to watch price, I was watching it live. I was looking for a specific opportunity to buy, but the thing about these moves and trading gold on these lower time frames is you could be in and out within a couple minutes of trading gold and catch 100, 200 pips and your day is done. It's just all about being patient. That's going to be rule 2, is patience. But understanding the structure, when we look at it, we got lower lows. We've been making more lower lows, lower lows, lower lows, lower lows, right? We've been respecting our highs, trading in the range, making lower highs, lower lows. Then we came into this area, right? When we came into this area, what it kind of looked like to me was a squeeze, right? What I mean by that is price is squeezing down. Think about it going from this big range like this to now we're just kind of like getting shorter and shorter, and it's getting smaller, and this little wedge shape is getting smaller. One thing I really like on lower time frame structures is when I see this type of wedge or squeeze pattern, whatever you want to say, but realistically just following structure. All right, lower low, lower high, lower highs, lower highs, lower low, lower highs, lower highs, lower low, lower high, lowest low, right? Understanding structure in this point, very, very simple. Just to clean this up a little bit, I'm going to go ahead and just draw some, let me just do this, do bearish. All right, so I'm going to go here. I'm just going to start there. Structure points. We're following these structure points. All right, so we're following these structure points. The most relevant thing in structure, regardless of the time frame, is looking for that shift of momentum, that change of direction, change of character, whatever you want to call it. It's all the same shit. Break a structure, it doesn't matter. When I have this lower high that puts in this lowest low, in theory, what should happen is price should pull back somewhere between these two lines. As long as it holds, it should continue lower, right? But the moment that we have a break of our previous structure, lower high, what we should determine is some type of retracement to give us an entry to then take us higher, right? Now, this model right here is one of my favorite models, the change of directions. If you do this on a higher time frame, you can catch insane swings. If you combine the higher time frame with the lower time frame and combine these two concepts, just understand that price doesn't know time and time doesn't know price, and just correlate that theory of just understanding time frame and multi-time frame analysis. This model right here that I just drew in the red, this is like the best model that I like to trade, whether it's a bearish market turning bullish or if it's a bullish market turning bearish, right? Now, in regards to it, that was rule one, understanding where you are in structure. So let me put the replay tool on really quick. And I love that it does this now. It says replay right here, so none of the freaking scammers can scam you guys any longer. I was watching price. First, I was watching it drop insane. Caught some shorts. I closed out. I missed out on the rest of the move. It was what it was. It doesn't matter. I made my money. Now, on this specifically here, what did I see? I saw price go up above. I saw price break up above our previous lower high. Now, in regards to our previous lower high, trading is subjective to how you see the market. I want you guys to understand that. It's all subjective to how you see things. My thought process is if it goes even slightly above this previous high, just like it did here, that to me is confirmation enough to say that, hey, we just broke structure. Price looks like that. We just broke structure. Maybe we should go higher. Now, first rule was to just understand where you are in structure. So understanding where we are in structure is that we just put in a higher high. So I'll come here, do that. I'll put that as blue. All right, cool. So we put in a higher high. So number two, when it comes down to trading the lower time frame in this style, number two is just going to be finding your discount / premium range and correlating smart money. And I'll just put SMC, correlating SMC. All right. So correlating SMC is just smart money concepts. So under finding your discount or premium range, what does that really mean? It just means this. It means since the market has technically structured up, we want to look at the range in the sense of premiums and discounts, right? So what does this mean? In the base of understanding supply and demand, you want to sell things for a premium. You want to buy them for a discount. Since we are shifting into a bullish change of character, direction, break of structure, shift of momentum, whatever the fuck you want to call it. Since price is going from bearish to bullish, we want to focus on buying the discount, right? What does that mean? Is anywhere down here we want to look to buy. So now you already have a 50% chance of understanding that, hey, as long as price comes down somewhere down here, this will be the most optimal area to buy. All right, cool. Now what do? Now we're going to throw our fib on here and we're going to look at the deepest level that we could potentially take this bad boy. If you guys follow me, you know I love this golden zone, right? This golden zone right here from the 61.8 to the 88.6. What do I do is I draw the box and then I extend it this way. Once I extend it this way, all I want to do is I want to look in this box for some type of smart money concept, whether it's a institutional candle, sell to buy to sell, order block candle, whatever the fuck you want to call it, whether it's a fair value gap, an imbalance, an inefficient pricing, whatever the fuck you want to call it, it's all the same shit. I just want to find something in this zone to make it make sense to enter off of. Cool. So for me, I see that, hey, this was the last candle down that pushed and made price the lower low, and that was the candle that forced price to make the move up that broke structure. So this candle here was the last candle down that broke past this previous low. It became the new lower low or the new liquidity grab since price went up and it put in this new high. So as we pulled back, what did I look to do? I waited, right? Another rule on the list should be having freaking patience, but finding your discount, premium range, and correlations. The last thing was just waiting for price to come and get into our general zone. I like to enter at the 50% with the stop below the low. The stops at the low for about 30 pips. Now, rule 3 is targets / exits. How should you exit this market safely? Now, even though I'm getting all these lower time frame confirmations, I have to understand that, hey, regardless of this, and this are lining up, this is still a very bearish market. My usual rule of thumb when I'm executing a trade, whether I'm buying or selling, is, hey, if I'm buying, if here's my entry and I'm buying, and maybe this is my overall take profit, I usually just go off the fib in the negative 27, the de-extension levels, right? So let's just say I'm buying here. I want a TP here. I usually take off, once price breaks the previous high, I usually take off 60 to 70% of my position there. I'm partial profiting, closing partials at this previous high. Now, one thing I will explain to you guys is this is a safe way to trade, because usually when it comes down to extensions, price doesn't go too much further than the previous high before it pulls back and goes lower or higher, or whatever the case might be. So in this specific case, I wanted to go for these highs up here. I wanted to go for these highs up here. And the reason why was because I saw there was this imbalance that got left behind. I thought, hey, if it goes up there, maybe it'll keep running, whatever the case may be. And, you know, that was my overall target. I actually ended up exiting the market somewhere around like the negative 61.8, and I'll explain why. I wanted to take profit up here. I ended up taking profit somewhere around this negative 61.8, and I'll explain to you guys why as we start playing into this here. Let me slow this down. All right, now price comes down. It's coming down. It's coming down. It comes down. It triggers us. It gets us into the market. It gives us a little fake out, and then we start running. Immediately, these are 1 minute candles. Understand, guys, we're trading the lower time frame, and gold moves very fast even on this lower time frame. This range from the entry to the high is about 170 pips. What I want you guys to understand is things happen so quickly that once price started moving and I started thinking, hey, maybe I should take partial profits, what I saw was this big candle just come through and spike right at the negative 27. When I saw that candle spike like that, I'm not gonna lie, even though it didn't get to where I wanted it to go up here, I ended up just taking my profit where it was at. It was either this candle or this next bullish candle here. And the reason being was in the sense of risk to reward, I almost 10x what I risked on this specific setup. This was a 1 to 9.2. My stop might have been a little bit bigger. It might have been like a 1 to 8, whatever it was. But regardless of this, the stop was like right here below the low. It might have been 1 or 2 pips. But regardless, I didn't expect this 1 minute candle to just come through and spike up the way it did. So when it did that, I was satisfied, right? I was just like, hey, it would have just spiked all the way. Amazing, hit the TP, exactly whatever. But when this happened, I'm not going to lie. I have another rule of thumb, right? And this is the last rule of thumb. Maybe you can go with that. 4. If you look at your phone and smile at your profits, ... take them. So that's another rule of thumb. When this 1 minute candle happened, I was geeked. So I was just like, yo, fuck it, I'm out. And I took it, and I took it right at the perfect time. And you guys see the entry and the exit on the screenshot that we posted. But then, you know, price went and continued the trend that it was in. But what I'll tell you guys is this, is right now in the gold market, I'm seeing this setup on the 1 minute and on the 5 minute multiple times in the week. Before I started recording this, I saw this same setup, just not today, but it was yesterday's price action on the lower time frame. Yeah, it's a lot of waiting. Yeah, it might be a lot of sitting around, but this is a setup to where you can maximize your potential RR, and not just that, but really crack the market. So hope you guys enjoyed this. If you did, make sure to subscribe, you know, like the video, comment. This is an amazing strategy that you can use to trade gold and catch amazing RR setups every single day, just trading the lower time frame. And then make sure you join our free signals chat too. First link in the bio.